Hi, good afternoon, everybody. We are back with yet another edition of Navigator for the September quarter. And our objective of the Navigator remains as it is. It is about navigating you through a sea of information across different asset classes, across different sectors, across global macros and domestic macros, and across how the interest rates and across how the yield curves have panned out in this quarter. So the framework of our presentation remains static. We take you across different drivers of returns, that is valuations, earnings, macros and flows, that is domestic and global, and the interest rate cycle. So what are we saying in this edition? In the last edition, we did say that we should maintain our equity exposure where it is, but we have seen a rally in domestic equity markets, right? And the rally has been quite steep and sharp in the small and mid cap space as compared to the large cap space. Large cap space has also seen a rally, but it has been quite moderate. How we see the Nifty index going beyond 20,000 and then coming back. And in the past 2 days, we see nearly 1%, more than 1% and 1% fall in equity market. We are awaiting a correction in the Nifty index, and we do say that it is appropriate to trim equity exposure and we await better valuations. Going to the second point, earnings trajectory has remained quite robust because profit margins have recovered and they have expanded in the past quarter. But going forward, as the interest rate hikes are getting priced into the market and they're working its way through the system, we say that the profit margins might not remain at the level they have grown in the previous quarter, and how the disinflation has set in the core inflation and how deflation in the WPI is easing, the profit margins might narrow down going forward. The sectoral trends are still similar, although a large one has happened. In the previous edition, we had mentioned that our favored sectors are BFSI, healthcare, and which remains the same in this edition as well. And we are also favored towards auto two wheelers in this edition. The fourth and the most important point is the focus on the asset allocation, given how Nifty has entered the expensive zone, how the small and mid cap space, the valuations in that zone has entered expensive valuations. We do recommend a prudent asset allocation and bringing in a more diversified exposure into the portfolio. Starting with valuations, how I've previously mentioned that Nifty has seen a rally, and post 2013, the upward trajectory or the upward re-rating in the Nifty PE has kind of skewed the average towards a longer has skewed the long-term average upward. Now, historically, whenever the Nifty PE has is more than 22 times, the forward 3-year returns have been rather subdued at around 8.5% versus when the P is lower, it has been 17.5%. Now, presently, the Nifty is trading around 22.5 times, and we do expect consolidation and correction to bring valuations to normalized levels over the next few months. Now, the Indian equity market has somewhat enjoyed a premium over its emerging market peers over the past few years. And this premium is a result of strong earnings growth and a much less indebted corporate India versus the EM peers. But with the interest rate hikes working its way through the system, the corporate interest payments are bound to increase, and it is bound to weigh down on the corporate profitabilities. And with the nominal growth normalizing, the in earnings growth is also normalizing, which will obviously which will obviously cause the premium on the Indian equities to revert to average levels. Moving to the small and mid cap space, especially in this space, the rally has been quite steep and it has been quite sharp. Now we see that the contribution of the small cap and the mid cap has been around 22% and 18%, which is close to the 2018 rally of 23% and 14%. Now, when we compare the small cap index to the BSE Sensex, that is the large cap index, and the mid cap index to the large cap index, we see that the ratio has reached the previous highs when the small cap and the mid cap space has rallied in the 2018. Now, with there is no way to kind of judge or to say with any confidence whether these ratios will continue to rally or has reached the peak or probably will reverse from here. But historically, whenever the corrections in SMIDs from such lofty levels can be avoided for a better investment experience. Moving on to the volatility. Now we all know that Nifty, the volatility index, has printed a low reading for quite some time now. Usually, in the previous editions, we've also seen that a low reading is essentially bullish. But when such low reading is kind of combined with high valuations or probably pricey stocks, it waves a red flag. And so we understand that a low reading in the volatility index kind of puts you in a comfort zone, but it also kind of undermines your ability to absorb any negative shock uh, that probably will play out in the future. So the current reading of volatility index in the context of valuations and momentum is throwing caution to the wind, and we need to probably stagger our equity purchases at this point. Now, for this slide, we kind of carried out an exercise. So we, for the past 2 decades, we took out year to date returns for NSE 500 and S&P 500. And we kind of filtered the top 12 years based on those year to date returns. And corresponding to those years, we took out the remaining year returns for S&P 500 and NSE 500. So what we observe is 2023 happens to be amongst the top 12 years in both NSE 500 and S&P 500. So there is no doubt about rally being this rally being sharp in 2023, and there is a multi-year bull market. But what is surprising is the remaining year returns are not as exciting. So while the average for the year to date returns is close to 30%, the average for the remaining year returns is a subdued 6%, and the similar pattern for the S&P 500. So after the market has rallied in the first half of the year, the returns in the second half of the year are rather average, and there is no guarantee that the rally will sustain in the remaining part of the year also. Now we move on to the next section, earnings. So while we've seen that the earnings have remained rather robust in the previous quarter and in this in year to date returns, but this might not pan out for the remaining year. So while the PAT contribution has in the Nifty has made a recovery in June quarter, 30%, we are not too sure if this will play out in the next quarter as well. Because how while in this quarter, in the June quarter, the deflation was at its maximum. It was around -4% in WPI, and that deflation has begun to ease. It is around -0.5% right now, and with that, the disinflation has also set in the corporate in the core inflation. So this kind of weighs on the corporate profitability, and in addition to that, the top line has also begun to slow, and the percentage of BSE 500 companies in top line contraction has begun to rise, and it is nearing the peak of 2015. Now, moving on, we go towards the macros and flows, the global trajectory and the Indian trajectory. So with Fed hiking its interest rates for almost a year, in the recent Fed policy meeting, they did take a pause. And so that kind of means that the interest rate hike is finally working its way through the system and hitting the banks and thus slowing the bank credit growth, which is quite evident on the fixed income securities we see. It will now, this rate hike is going to affect the liquidity in the economy and it is going to cause a slowdown. So this interest rate hike is not without consequences. While in US the goods inflation has seen a sharp downturn, it is majorly because of the supply ease. But the stickier part of the inflation, which is the services inflation, has remained where it is, and it is very sticky to come down, especially the and it is especially because of the housing inflation. Now, with excess savings in the US taking a breather and the demand easing down a little, we might have seen some downturn in the services inflation, but for like a substantial fall in the services inflation, we will have to like calm down the labor market a little, which has been quite robust so far. While there is some moderation in that aspect, for a more pronounced, what do we say, pronounced effect in that aspect, we have to kind of wait for the rate hike to further work its way through the system. As far as India is concerned, there is strength in select indicators. Uh, we see that the Indian composite PMI has outpaced the global composite PMI by a significant margin. But what is what but in the indicators there is worry when we see a deflationary gap in the real GDP and nominal GDP. So this is basically because of the disinflation setting in the core CPI, because of which the GST collections have also slowed down. So this gap is because of the disinflation setting in, which has kind of weighed on the GST collections. Now the money supply has also begun to ease. It peaked in June 23, but with RBI's proactive measures in that aspect and with it maintaining the ICRR at 10%, it has begun to ease, and it is also combined with a kind of a slower velocity of money. So velocity of money kind of tracks your economic activity, and when it slows, it means that there is a slowdown in the economic activity, and which is further validated by a disinflation disinflationary trend in the core CPI, and also deflation setting in deflation easing in WPI. Now, as far as the US debt and the Indian debt holdings are concerned, India has been very dependent on the central bank and the domestic bank for its debt, to finance its debt. But such dependency on the sovereign is not it kind of undermines the central bank's ability to exercise an independent monetary policy. The central banks are the bankers to the governments after all. But while the Indian central bank has now reduced its holdings in the Indian government securities, even amidst the quantitative tightening, the Fed still holds a significant portion of the outstanding US debt. Moving on, we see that while in the textbooks we have read that savings is equal to investments, that concept is kind of restricted to a closed economy. But what we see is this savings and the relationship between savings and investment is all the more crucial for an open economy. So when savings are maintained in surplus to the investment, it kind of helps the economy not only to fund its own growth but also to maintain a current account surplus. So in this chart, we see that all those economies which have savings and surplus of investment have managed to maintain a current account surplus. But as far as India is concerned, we are inching towards a current account deficit, but a current account surplus still remains far-fetched. Now we move on to different sectors. The DSP Capex tracker, which shows that most economic macro indicators are looking healthy. And in the June quarter, we almost see shades of blues in all the indicators. The IIP has run really good in this quarter, especially in terms of steel production, the cement production, IIP mining. Personal loans have grown significantly in the month of August, despite lending rates being high. So, which kind of validates a good demand condition in the economy. Now we have argued about the margin expansion, which is majorly because of the lower raw material cost, which is because of deflation in the WPI. And the sectors which have made the most out of it is the cement sector, the power sector, the auto sector. But we're not too sure if this trend is going to continue in the coming months. Flows. While India was due to get its fair share of flows, we have been getting in a few sectors starting the year 2023, from the start of the year 2023. But the sectors which have benefited in this cycle, such as autos, financial services, industrials, have gotten more flows. Cumulatively, however, with relative strength of Indian macros, better earnings potential and dollar weakening, flows to India should benefit. Moving on to the healthcare sector, while the operating cash flows have been increasing, capital expenditure has come down substantially, leading to a sharp increase in the free cash flows. Now, this drop in capex has been majorly driven by the lower spends of companies for the US generic market. BFSI sector, we continue to favor this sector. We see that the profit after tax as a percentage of total income has been increasing for quite few years now, and the NPAs have lowered in the June quarter significantly. Also, the bank Nifty index has underperformed the Nifty index. At the same time, the valuations have gone through a churn. Now, as measured by the price to book value, the Nifty bank index traded below 2 times in August 2023. And historically, if you were to keep investing in the Nifty bank index during periods when its PB is below 2 times, it does deliver exciting returns over the next few years. Moving on to the last section, that is interest rates. This time it is a pause with a purpose. Now, for India, we see that the yield curve has been in its traditional upward sloping shape, but a quarter ago it has flattened, and the latest yield curve shape is all the more flattened. So it is going from flattened curve to a flatter curve, because there has been a sharp increase in the short term interest rates because of the interest rate hikes. For the US, from a upward sloping yield curve, it has gone to a to an inverted yield curve, to again a flattened yield curve. Now, how long can US sustain inverted curve without compromising growth? So we have gone from an inverted curve back to a flat curve, but we still await recession. And there there is a crucial observation that it is the inverted yield curve moving towards reversion, which then signaled an imminent recession. So we come back to the Fed hiking its interest rate. So we do see in this chart that this time the hike has been the most steep. It has gone from nearly zero interest rates to five and a half interest rate. However, a widening fiscal deficit despite the record low unemployment is striking in this regard. Now, while a premature rate cut might weigh on inflation and weaken dollar, the robustness in the labor market will have to be withdrawn for a substantial fall in the stickier component of inflation's basket. Now, there are signs for the labor market strengthen. There are signs that the labor market strength has begun to wane. The higher interest rates are continued. The higher interest rates uh, are continued and will maintain that stance and will be high for a long term now. So a rate cut is quite far fetched for now. How it was predicted to be in the second half of 2023, then it began to be predicted to be in the first half of 2024. The present prediction it is to be in the second half of 2024. Now, The rate hike has been steep, and it will not come without consequences. It will it will weigh down on the growth in the US. Uh, Now, with US and India bond yields moving together in the same direction, we have seen that the Indian bond yields have kind of across Indian yields across maturities have kind of converged to a single point, which reassures the flatness of the Indian yield curve. Now, across the globe, the rate cuts are getting priced in, but in India, rate hikes are getting priced in. Now, this asymmetry leads to asymmetrical odds in favor of long bonds, and India's fiscal situation and inflation trajectory remains much more benign, which kind of creates an opportunity to own long bonds at 10-year yields, which recorded a recent print of around 7.25%. So this has been the now we'll move to summing up what we have uh, discussed so far. For equity, we have been saying throughout the presentation that it is prudent to exercise caution as valuation comfort is no longer available. Equity allocation to be reduced and brought back only when markets are available at average valuations. For debt, tactically add duration when India GSEC at 7.2 to 7.25%. For commodities, gold to oil ratio indicates that the potential for gold to do well over time. The crude oil is bound to spike given the supply disruptions in that aspect, and it has to be monitorable going forward. That's it.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.